Hello and welcome to our latest Aon Market Insights overview. Today, looking at reinsurance. My name's Ben Rolfe. I'm Chief Broking Officer for Aon here in Australia, and I'm joined today by John Carroll, Head of Broking at Reinsurance Solutions. As we start to get buyers ready for upcoming renewals and help them understand the market environment in 2021, I thought it was a really good opportunity to get John in to talk to us a little bit about the 1st of January treaty renewal season that's just happened, and importantly, what that might mean for insurer behaviour in 2021 and the general market landscape as we move forward through the year. So, John, reports would suggest that the reinsurance buyers fared slightly better than anticipated in the 1st of January treaty renewal season. I'm keen to get your thoughts and observations about that, and importantly, some of the the key areas, of focus.
Sure. Thanks, Ben. Look, it's certainly true that pricing outcomes were a little bit better than anticipated for buyers, for most buyers, but certainly there were fairly consistent increases across the board at the sort of January renewals. Of more interest than price, though, was coverage and capital deployment. With respect to coverage, the main areas of concern for reinsurers are infectious disease, silent cyber, and contingent business interruption exposures, and essentially because these are areas that introduce both catastrophic and potentially systemic exposures to their balance sheet. And whilst there's plenty of capital available to the market, deployment of this is an issue, and areas that are producing significant volatility such as bushfire liability, PI, Side C, D&O, hazardous occupations, and certainly anything involving aggregate catastrophe exposures are sort of seeing capital allocations reduced from most of the main reinsurance markets.
Thanks, John. So, what it does sound as though, a continuation in many respects of some of the themes and, that we started to see emerging in the back end of 2020. How did this compare to, the areas where insurers were looking to purchase, and how successful were they at that?
Yeah, look, I think it's fair to say that there is a bit of a disconnect between supply and demand. On the one hand, insurers are looking to find solutions for many of the problem areas that we've just sort of touched on in order to stabilise their results and continue to provide capital and capacity to their original insured customers. At the same time, though, reinsurers are also looking to focus on reducing volatility to their balance sheet. And during 2020, we saw a fair amount of new capital come into the market, but the deployment of this is more to your traditional lines of business and not looking to really extend itself into the more hazardous areas of exposure. Importantly, the majority of this new capital actually came to existing players who were looking to take advantage of the firmer market, and about 25% of the capital went to new startups, but they're very much focused on more the short tail lines of business.
So, unfortunately, no silver lining, therefore, for some of the most troubled areas of the market, PI, D&O, for example.
Yeah, no, not at this stage, unfortunately.
Yeah. One of the trends that we're starting to see is a disconnect on some of the short tail lines in particular between renewal pricing and new business pricing given by insurers. We're now entering the 4th year of remediation for many insurers, and it's starting to see a focus on portfolio pricing lift rather than account-specific underwriting by many insurers. As such, pricing adequacy on a new piece of business may differ quite dramatically from an incumbent's renewal requirements. What is the reinsurance view on technical pricing adequacy in Australia at the moment? And do you see this as a trend that we could start to see becoming more prominent as we go through 2021?
Yeah, look, reinsurers are probably a little behind on their remediation efforts compared to the insurance market. But yeah, across many parts of the business, I'd say both insurers and reinsurers are coming to the view that pricing is a relatively adequate sort of level at the moment. But that said, there's still large areas of volatility in their portfolios, and that's driving unprofitability and is likely to continue to put the firmness in the pricing environment for the foreseeable future. And to your point, though, I think those buyers willing to test their current capital providers may well, in some cases, get a very different outcome because it's often easier to take a more favourable view on pricing with a new piece of business than it is with a piece of business that has some legacy claims in it.
Thanks, John. So, I mean, it does sound, I guess if I take all of that into consideration, it does sound as though buyers need to be more aware, than ever around their risk appetite and really start to analyse, their risk tolerance and understand the levers that they've got, available to them to maximise the capacity and the capital available to them in the market. And I think if we can really help buyers to think about it in that way, we can really start to optimise not just risk transfer pricing, but importantly total cost of risk.
Yeah, exactly right.
So we've seen an increase in discussions around captive utilisation in recent months, with buyers keen and probably more keen than ever to explore the benefits of captive utilisation, and some examples of this might be, to start self-insuring things like, employee benefits, or perhaps as a fronting vehicle for specialist reinsurance capacity, or enable to sort of, access alternative risk transfer opportunities. If I think about the latter, we've seen a flurry of alternative risk capital come into the market in recent years, and some of that with great success, but we've really not been able to sort of, bring that particularly successfully to an individual buyer level, within Australia. Do you think that we're getting close to the minimum stage gates being met for individual policyholders here in Australia?
Yeah, I think we are. As I sort of alluded to before, it really gets down to buyers having a clear idea about risk appetite and the cost of risk for themselves and how much they're willing to transfer. And in the past, the biggest hurdle has been the price expectation difference between buyer and sort of seller of these products. What we're sort of seeing is that these solutions are pretty prevalent in the US and less so in Australia, but Australia's sophistication and insight and access to data has improved to make these sort of transactions much more feasible for buyers. Parametric and alternative risk solutions are readily available, and reinsurers are looking to deploy their capital in Australia and New Zealand. But what we're sort of seeing, though, is that reinsurers are not geared up to be retail insurers, so from an infrastructure perspective. And that's where you bring in captives and protected self-captives such as White Rock. And Ben, we've worked on a number of these in the past and brought ideas to the table, and I'm sure that's going to continue.
So, John, a huge thanks for your time today, and hugely helpful as we start to think about helping buyers through their renewals in 2021.
Thanks, Ben. Been a pleasure.
So I hope you found that useful, and look out for more Aon Market Insights coming soon.